Okay, shall we start? Prasanga?
Yes, please.
Right. So now we are going to get into working capital policy. Just give me a second once. Yeah. So now we are going to get into the working capital policy, right? So objective of working capital management and by extension the cash management is to minimize the cost of maintaining liquidity, right? So as we have seen now, so always maintaining liquidity, there is an associated cost, right? So this is how to manage that, minimize that. Access to cash and assets that can readily be transformed to cash to pay current obligations while guarding against the risk of liquidation or insolvency, inability to pay the whatever the obligations that they come due, right? So basically, maintaining the liquidity is costly. If you want to have access to cash and assets that can be readily transformed to cash to pay the current obligation, right? So always, so that is maintaining liquidity is that either you have good enough amount of cash or a very liquid asset that can be immediately or readily transformed to cash to pay your obligation. So to have those liquid assets, so there is a cost of maintaining that liquidity, right? We need to minimize that, but to minimize that, what we can do is you can limit the amount of cash that you have or cash close to cash assets that you have. But when you minimize that by doing that, what happens is you will run the risk of liquidation or insolvency because you may not have enough money. If you maintain it too thin, you may not have enough money to meet your liabilities or the obligations when they fall due. So then you may run the risk of liquidity or insolvency. So therefore, you need to match those two. Businesses will adopt a working capital policy or a strategy that ranges from aggressive to conservative, right? So an organization's working capital policy can be very aggressive or it can be a conservative working capital policy, right? And the choice of determination by the context of the organization, right? So whether an organization has an aggressive working capital policy or a conservative working capital policy is actually the choice is dependent on many factors. The size of the organization. If it is a very big organization, probably you can be more aggressive in terms of your working capital. You don't have to be very conservative. If it is a company which is financially strong, or if it is an industry which is a stable, established in one industry, in those situations, you can be aggressive. But if it's a small organization, not very strong in financially, if it is a very vulnerable industry or unstable inventory, so then you can't be very aggressive. You obviously have to be conservative in managing your working capital, right? And also, it will depend on these factors, the context of the organization, and can also depend on the management culture of the business. Certain businesses are very aggressive, like they are very highly geared, and they borrow and they take the risk. So that is a culture of the organization. And you see how the big groups in Sri Lanka, they're very highly geared, right? They're very, people are not sure whether they will continue or not, right? So this aggressive, but that's because not they are big, but also it is because they are management culture. But on the other hand, there are other organizations, their culture is different, where their culture is different, they are very conservative, even though they are big, even though they are strong financially, even though they operate in good, stable industry, still their culture is that they want to be, by nature, they want to be conservative, right? So that is what determines those two aspects. Okay, right. Having said that, a conservative working capital policy uses, okay, before I go into that, any comments on this up to what we discussed so far, Prasanga? Are we okay?
Go ahead, sir.
Right. So this is actually the all throughout this discussion about this part of it. It is basically you manage these two sides of maintaining liquidity, the other part, and how well you are going to manage the cash. That is what you're going to discuss today. So conservative working capital policy, if it is an organization, the conservative working capital policy, which means that you can use the long-term debt to great extent to fund the current assets and minimize the liquid risk by increasing the working capital. So basically, if you fund major part of it, of your working capital, with long-term funds, right? They use long-term debt to a great extent to fund the current assets. If you use a lot of long-term funds to fund the current assets, so which means the long-term funds may not be determined, the funders, funding organizations may not demand the repayment of them within a short period of time. So therefore, liquidity risk is less. So therefore, conservative organization will use as much as possible or a greater proportion of relatively long-term funds to finance the working capital. Right? Whereas an aggressive organization may not have the long-term funds is supposed to be costly. So, but an aggressive organization may want to fund a greater part of their working capital, not through long-term funds, but mostly they'll be managing with short-term funds, where the financing institutes can decide not to offer these long-term funding options, right? And they may demand early settlement. They may say all those things can happen, right? So that is the difference, right? Now, having said that, a conservative firm will ensure adequate cash, inventory, and supplies are available. Obviously, if it is a conservative company, they don't want to take risks. They want to ensure that you have enough cash, right? So that you will not run the risk of not having enough money to settle if someone is asking for a payment, right? And also you have enough inventory, right? So that whenever you want to, your lines can be your outlets or your channels can be filled with the finished goods or whatever the inventory when they are when they require, and also enough supplies are available. So you are very conservative. You don't want to lose on any of these places. At the same time, you don't want to take too much of risk, so therefore you don't have payables. Minimize payables, as little payables as possible. You have more assets and less payable. So when you do that, you forego potentially high returns from investing in long-term assets and instead keep additional working capital available. Forego the potentially higher returns from investing in long-term assets and instead keep additional working capital available. So then what's going to happen is, obviously when you, most of the time when you invest in long-term assets, so you have potentially you can earn higher returns, right? But what you, a conservative organization, what they do is, instead of investing in high return long-term assets, they may want to keep money as additional working capital availability, so that they are conservative. They don't want to take risks, right? So when they do that, so basically you tend to have more, because your assets are going to be funded, a greater proportion is not going to be funded not through the short-term funding, but through the long-term funding. When you do that, you have your current assets and current liabilities. And your current ratio is current assets divided by current liabilities. Acid test is current assets minus the inventory divided by current liabilities. So when you try to be conservative, funding a greater proportion of your current assets, not through current liabilities, but through long-term funding, so then your current liabilities proportion comes down. So as a result of which your quick ratio, the current ratio is going to increase. So you will be maintaining a high current ratio and high acid test ratio, because your short-term borrowing is relatively lesser and you're not going to be funded through the long-term funds are not going to be invested in a lot of long-term things. Any questions about this? Is that clear?
Both conservative and aggressive working capital
Yeah,
policies.
so here we went detailed into conservative. But then let's go the same way on the other side of the coin when you're more aggressive, right? So when you have more aggressive working capital policy, places a greater reliance on the short-term financing. Instead of you having reliance on the short long-term financing, you are depending more on the short-term financing in the firm of a form of trade payables and bank overdrafts. So instead of funding your current assets through long-term loans, a greater proportion of funds will be derived through payables, supply credit, and bank overdrafts. Right? So which means you may have the same amount of current assets, but if you fund it through long-term assets, the conservative ones, current liabilities are less, your current ratio is high. On the other hand, if they are going to fund them as much as possible through short-term funds, so then your current liabilities are more, so your liquidity current ratio, the quick asset ratio will be lower. Like, so these are the things to probably keep in mind, MCQs, etc. They can ask these things, conservative versus aggressive, asset ratio, quick asset ratio, the relatively which one is higher, lower, those things just keep in your mind. So a firm with a more aggressive working capital policy will have a lower level of net current assets. Obviously, conservative working capital means you said a greater proportion is going to be funded through current liabilities. So that, which means the current assets minus current liabilities, that is net current assets, will be smaller. It's a lower level of net current assets because current liabilities are more in comparative terms than will an equivalent firm with conservative working capital policy. That's clear, right? When it's aggressive, your net working capital is aggressive, net working capital is thinner because your current liabilities are fairly heavy. But if it is a conservative, your current liabilities are lower because you're going to fund through the long-term funding. So then your net working capital will be higher, right? And the liquidity ratio can be used to assess the trends in the working capital management. So you look at your liquidity, your current ratio and quick asset ratio. If you feel that you're going to be aggressive in terms of working capital management, so then your liquidity ratio and the quick ratio may be coming down. On the other hand, if you feel that the organization is going to be conservative in terms of working capital management, so that means your quick ratio and the current ratio is going to improve. That is, this is how you can make a judgment by looking at them. Yeah. Is that clear, Prasanga?
Yeah, sir.
So it's not like I told you at the beginning, they are not complicated things. Once you get the rhythm of the momentum, it's fairly straightforward. Permanent working capital is the minimum level of current assets maintained by a firm. The level is expected to increase when the firm grows. So basically, permanent working capital is depending on the way the company is going to manage. The minimum level of current assets to be maintained is your permanent working capital, right? Of course, when the company keeps on growing, your permanent working capital may keep on increasing. Obviously, the minimum amount of working capital keeps on increasing. But more important thing, permanent working capital generally is financed with long-term debt. So a part of the working capital, which is considered as permanent, they will be funded through long-term debt. Because the permanent working capital is sort of the fixed working capital that is going to be funded through the long-term loan. Financing with short-term debt is risky because assets may not be liquidated in time to pay off the debt at maturity. Right? Say, if you are going to fund the current assets, the permanent working capital through long-term loans, obviously long-term loans, the bank may not stop you utilizing the long-term loan, and then you will continue to use them. So therefore, you are more protected. But on the other hand, if you use a lot of short-term funds to fund the long-term, whatever the current assets, so then the problem is when the current liabilities are demanding from you, you may not be able to liquidate your inventory and debtors and then get the money to settle them, right? That can be a problem. So that is, I say, permanent working capital generally is financed with long-term debt. Financing with short-term debt is risky because assets may not be liquidated in time to pay for the debt at the maturity. You may not be able to liquidate and pay the debt at the maturity, or interest rates may rise. That is also there. When you borrow short-term funds, interest rate may rise. and the loan may not be renewed. The bank will say, you get into a difficult situation, or the economy going through a difficult situation. So then the bank may say, okay, we are not going to, you have a working capital funding, but we can't give you, that funding. So that is a problem. That is a problem that can come. Is all about, right? So now you understand it, right? So more short-term funds you use, you take a greater risk from different perspective. More long-term funds that you have, you take a lesser risk. Is that clear, Prasanga? These ideas, are you clear with the ideas? Prasanga?
Yes, sir.
You're sure, right? I'm not going too fast, so you're okay, right?
Yeah, yeah. Please.
Yeah, sure. Just give me a second. I just also wanted to show you something, a diagram, which is of course may be available anywhere on the internet, but I just wanted to show you this. It gives you a give me a second, right? I'm looking for I'm going to share. Okay, my screen is going to be shared. Can you see this, Prasanga?
Yes, please.
Right. Okay. Now, basically, now we have fixed assets. Are you familiar with this diagram? We'll explain it, right? Now we have our fixed assets, right? We have our fixed assets. Ideally, the fixed assets are long-term assets, so they will have to be funded with long-term financing sources. So fixed assets will be funded through long-term financing sources, right? And then on top of that, you have your current assets, right? Your current assets will be on top of your fixed assets, just inventory, debtors, and the cash requirement. And then say this is basically your permanent working capital is this. Basically, what is the minimum amount that when the business keeps on growing, the permanent working capital requirement also keep on increasing. But on the other hand, you may have temporary working capital is over and above this, your working capital. What would what are the factors that will give rise to this wave? How can this wave arise?
That's depending on the nature of the business. Maybe
Business,
the
like what?
maybe payment.
These are seasonalities. Like say before the season, you stock inventories and you offer credit, but then after that, it will be declining. So these are seasonal products, the New Year season, holiday season, or harvesting season, or sometimes the raw material availability is within a limited period. So you have to acquire raw material and keep in inventory. And then you may use that inventory until the next season it is available. And sometimes it may be natural material which you take from sea or somewhere, some mineral or something like that. Then again, availability of the raw material where you can harvest them, it could vary. So that's a temporary due to the working capital. These are the business cycle, the seasonal variation. Is that clear?
Yeah.
Right. And then, so if it is, you can see if it is a conservative strategy, which means definitely the entirety of your permanent working capital, you're going to fund with long-term funds. And a part of your temporary working capital also, you are going to fund with long-term fund. Part of your, these are your temporary working capital. So this is a permanent is up to this. This is your permanent working capital, and part of the temporary working capital facility also, you are going to have funding facility, long-term funds up to this level. So that means you are very, very conservative. On the other hand, if you are very aggressive, that means you are not going to get that much of temporary permanent working capital, because you may say permanent long-term funding because it's costly. You are getting only up to this level. even a part of your permanent working capital is not going to be funded through your long-term loans. You're funding only up to this level, only you're going to fund through a long-term loan. The balance is you're going to have working, everything is going to be working capital. The short-term loans. If you're aggressive, you will be funding only up to this point through long-term financing. If you are aggressive, if you are conservative, you're aggressive, up to this level, you'll be funding through long-term. This conservative strategy and this aggressive strategy. Okay, the hedging strategy, what we are going to discuss about that, actually it's matching the cycles. Right? So this is the concept that we talk about. Is that clear?
Yeah.
Okay, good. So permanent working generally is fine. This is what we have been discussing. Okay, temporary working capital fluctuates seasonally. We already saw that. As the firm needs for current assets change on a seasonal basis, temporary working capital is increase and decrease. So it varies. It goes through this wave movement. For example, a retailer would like increase in inventory levels ahead of major holidays. Obviously, ahead of major holiday seasons, New Year, Vesak, Christmas, whatever, or school holidays. So then you need to increase the inventory level. Spontaneous financing is the amount of current liabilities such as trade payables and accruals that occurs naturally in the ordinary course of business. Right? So ordinary course of business, when the business volumes keeps on changing and all of that, the spontaneous financing through current liabilities and either your trade payables increase or accruals increase. So that will happen in the normal course of business. Trade credit is an offer of credit terms by the supplier. Now, so this is the funding part of it, right? So spontaneous financing is what comes through current liabilities, obviously. Trade credit is an offer of credit term by suppliers. Supplier give you credit term, so then that is trade credit, obvious. Accrued expenses such as salaries, wages, interest, dividend, and taxes payable are other sources of interest-free spontaneous financing. Other than the trade credit, you are getting it free most of the time. The supplier gives you credit period to settle. So you're not paying very likely, if it is a known to the industry, you're not paying anything extra to get that trade credit. So it's coming free. Accrued expenses, whatever the salaries, wages, interest, dividend, tax payable, or whatever it is, if you're not paying at that time, right? So then that is also coming the interest free. That is also spontaneous finance. Typically, a firm's temporary working capital cannot be financed only by spontaneous finance. So that is what we were showing in that diagram. It can't be, this can't be fully funded through working capital financing typically. So that is why your permanent working capital, part of that will be conservative, part of that will be funded through permanent loans or long-term loans. That is what it says. Okay. Permanent working capital, temporary working capital, aggressive or conservative policy, all that has been discussed here. Is that okay, Prasanga?
Yeah, sir.
Right. Let's continue. Then we go and look at this about trade credit. Very simply, a vendor has delivered goods and invoiced the company 460,000 on terms of net 30. So within for a 30-day credit period, the vendor delivers the goods and invoice the company 160,000. So which means the company has effectively received 30-day interest-free 160,000 loans. Once the vendor is delivering 160,000 worth of goods with the term that you're supposed to pay after 30 days. So that means for the 30 days, this 160,000, you are going to get it free. There is no cost associated with that. So that is what we mean by trade credit. Okay. And then it says that a firm must decide whether to use short-term or long-term financing. The company will have to decide whether you are going to use short-term or long-term financing. Decision is aligned to the choice of the aggressive or conservative working capital policy. Obviously, this is what we have been discussing. the interest rate on the long-term debt is usually higher than the short-term debt. That's what I told you. Long-term debt typically are more expensive, more costly than the long-term, short-term debt. So that is why when you have a good conservative working capital policy, you have more long-term funding sources to fund the working capital. So obviously long-term funding is coming at a higher cost, but to be conservative, avoid risk, you are going to willing to incur a higher cost. So the interest rate on the long-term debt is usually higher than the short-term debt. That the long-term financing is more expensive than short-term. However, the shorter the maturity schedule of a firm's debt, the greater the risk that the firm will be unable to meet principal and interest payments. On the other hand, longer term, there is more chance that you can plan and you can accumulate funds to meet the principal repayment, right, and the interest payment. But on the other hand, the shorter the maturity of a firm's debt, the more and more you have short-term credit, the overdraft and the short-term loans, TR facilities or whatever it is. So then firm takes a greater risk not having enough money to meet the principal and interest payments. Right, so the longer term funding is costly, but the chances of you not being able to meet the obligations is less. Short-term funding is cheaper, but of course, you are taking greater risk. In general, short-term financing is more risky and less expensive than long-term financing. So short-term loans are less riskier, right? Because you need to pay them within a short period of time, and you may not have enough money at that point of time, right? But less expensive. It's risky, but the interest rate may be, the cost may be lower than the long-term borrowing, obviously. Ideally, a firm should be able to match the offset each element of the temporary working capital with a short-term liability of similar maturity. Ideally speaking, what you can do is, and every asset can be matched with a liability of equal liability. Say short-term loan could be obtained before the winter season and repaid within the collection from the holiday season. Just give me a second. Give me a second. A short-term loan could be obtained before the winter season and repaid within the collections from the holiday season. So just that basically matching the timing according to the season. One way of matching the short-term, the seasonalities with the appropriate cycles of borrowing. So that is basically all about your working capital management, broadly speaking, conservative versus aggressive, and debtors, inventory, how you could manage them, how you can match the requirement versus funding source when you're aggressive and conservative. That is what has been discussed. Okay. Are we okay, Prasanga?
Yes, sir.
Right. Okay. Shall we try to continue till about 9:30? We are okay, right? You're tired?
Whatever, because others are not here. No, that's what I was thinking.
Well, see, this is not a difficult area. On the other hand, for me also, keeping without finishing them is pressurizing, but this is an easy area. So therefore, we'll just continue that cash management part, because otherwise there are so many things we are keeping halfway through. Let's try to see. These are not
Okay, okay.
difficult things. It's just a matter of just we just keep talking to each other, and then it's a easy going. They also can just listen to this once, probably they can understand it. Now you understand these things are not very complicated, right? It's a straightforward things you already know, but probably you are learning them according to a structure,
Yeah, yeah.
right? So we'll quickly go through that. These very simple things that we speak of here. Now one is about the cash forecasting and budgeting. right now, because the points after this, we'll be looking at the cash part, and then later we'll be looking at the other parts of the current assets. Basically, we'll be looking at receivables management at the next lecture, inventory management at the probably receivables and the inventory management at the next lectures, and then they'll just touch upon just in time and all of that. MRP, little things they'll be covering. So today we are going to look at quickly the cash forecasting. At least part of that we'll go through that so that we are somewhat eased, right? Okay, just when you look at why we need to hold cash, there are three motives. One, transactional motives, we need to have cash. Like, because whenever there is a transaction as a medium of exchange, we need to have cash. That is a transactional motive of having cash to meet a transactional requirement. On the other hand, there can be unexpected contingency, right? Suddenly, we may have to settle a creditor, or we may have to buy some material. You may have a sudden demand or something like that, and then to capitalize on that precautionary unexpected contingency as a precaution, you may need to have cash. So there is a transaction requirement and precaution requirement, and then apart from that, sometimes there can be this unexpected contingency, unexpected commitment only, you are precautionary. But speculative requirement of cash management is that sometimes you may see an unexpected opportunity. To make use of that, you may need to have cash. So then that is a speculative. Meet the transaction and to manage an unexpected contingency, or to make use of an opportunity, we may have that. So these are the different points, different purposes of having motives of holding cash. Very straightforward. The goal of cash management is determine and maintain the firm's optimal cash balance. Remember, with regard to all these assets, it is the goal should be having the optimal cash balance, right? Cash is generated from the elements of working capital and used to settle the obligations of the entity. So when you decide at the optimum cash balance, usually the cash is generated from the elements of working capital, right? Say your working capital cycle, these elements you generate cash, especially your raw material gets converted to working capital, work in progress gets converted to finished goods and gets sold, converted to debtors, and debtors pay you get cash, right? So that is what happens. The level of cash needed is determined by how much of cash required for the business will vary depending on many factors. So as the next couple of points, that is what we are trying to look at. How much of cash required is determined by the speed with which the elements of working capital can be converted to cash. Certain businesses, say FMCG or inventory, can be quickly converted to cash. And you may not be selling it on credit. So your customers will pay you immediately. Right? On the other hand, if it is a construction equipment or something like that, so then your finished goods cannot be sold fast. And even if you sell it, the industry settlements will not be coming within a short period of time. So the speed of your elements of working capital getting converted to cash can be different. And certain businesses, your raw material can be easily sellable and you can convert it to cash. Some businesses, your raw material may not be sellable in raw material form. And some businesses, your working capital conversion period to finished goods is shorter. Right? Some businesses, it takes longer for you to ship building or something like that. It takes longer to go through that conversion. So therefore, the speed with which the elements of working capital can be converted to cash could vary depending on the business. Flexibility the firm has in settling the obligations also will vary. Certain businesses, you have good supplier relations, or the nature of the industry is such that you always have the flexibility to talk to a supplier and get a little bit of more time without any problem or without going into bad books of your supplier. So their flexibility is there, that whether you have the flexibility to your suppliers or not will also a factor that will determine the level of cash required. On the other hand, the readiness and the speed with which the firm can gain access to short-term financing. Some businesses, whenever you need it, probably the size of the business or whatever the parameter scenario, you want short-term financing, quickly you can go and get it from the banks. Some businesses, you need cash, it takes time, either your reputation or the industry or the situation or whatever, you need time to go and get access to short-term funding. So that also, depending on that, your cash balance required to be maintained will differ. Size and the strength of the business, obviously, a stronger business, you may not need to have a lot of cash, but weak business may have to have more cash. Uncertainty faced in the industry, uncertain industry, you need to have more cash. Less uncertain, you can have less cash. Potential investment or acquisition, the firm may be considering. If a company is considering an acquisition of something, acquiring something, an asset or a business, or potential investment, so then again you need to maintain cash. So now these are the factors which will determine the level of cash that you need to maintain in the business. Any comments? Prasanga, are we okay?
Yes, sir.
Right. Okay. Some cash may need to be held as a result of banking borrowing arrangements. So that also happens, sometimes, because say you want to have a facility, the bank may give you a facility without having full collateral, but they may want you to maintain something like cash balance. These are mostly, but in some of these areas in this part of the topic, they use this from American terminology, and we may not be familiar with that, but you need to know this from their terminology. So compensating balance is like a margin that you maintain with the bank, right? Minimum amount that the bank requires the firm to keep in checking account. That is, checking account is a current account. The money that is required to be kept as margin probably in the checking account, because you're not earning any return, that is compensating balance. Because when the compensating balance are non-interest bearing, obviously if it's a checking account or current account, they don't earn interest and are meant to compensate the bank for various services rendered, such as unlimited check writing. So you can write checks over and above within the balance, the facility given by the bank, but your cash may be 100,000. You may have a facility of 500,000 on that cash backing as well as your other reputation. So therefore, with 100,000 in your account, you can write checks up to 500,000. So for you to get that capability, that you need to maintain that compensating balance, right? So various services rendered, such as unavailable, these are the services provided. These funds are unavailable for short-term investment and therefore idle cash. So you'll be maintaining them in nominated current account of your bank, and they are just idling. You're not earning a return typically, right? And but you can't use them money for investment. They are just idling without a return. That is a compensating balance. Any questions on that? Is that clear? Prasanga, are you okay?
Yeah.
Right. Idle cash, on the other hand, incurs an opportunity cost. In a bank organization, if you have idle cash, obviously there is a cost. Why? There is an opportunity cost. This rather than keeping the money, idle money, thinking that you may have a need, you invest that somewhere, you can earn a return. So return. So obviously, idle cash incurs there's an opportunity cost when you have idle cash. To offset this cost, firms invest their idle cash balances in marketable securities. So if you may need to maintain certain cash balances depending on those situations and whether your company is aggressive or conservative or whatever, right? So then if you just hold idle assets, they are not going to earn you in return, right? That's an opportunity cost. So what you may do is you may invest them in marketable securities. What is meant by marketable securities is, remember, you know what they are. They are low yield because you are trying to get a return, but you want to be able to withdraw the money soon. So therefore, your return or the yield will be lower, and they are low risk. They are marketable at any given point of time. They are low risk instruments that are traded on highly active markets. Their risk is lower, return is lower, obviously, trade on highly active market. So that is at any point of time, if you want to sell them and get cash to meet your obligation, they can do it because they are trading highly active markets and commonly referred to as money market instruments. So basically, this is money market instrument. They know there are various types of money market instruments, and marketable securities provide liquidity and security benefits. So if you have marketable securities, that means you get liquidity benefits and security benefits. Liquidities, you can sell it fast and convert it to cash and use it. And security benefit is they are safer, low risk. If these are the benefits that you can get. Is that clear?
Yeah.
Right. Let's move on. Now, having said that, a firm will be able to hold less cash the more confidence it has in the ability to forecast or budget future cash flows. A firm will be able to hold less cash. So if the company is more confident, right, that you have the ability to forecast the cash flows for the future, so then they will be holding less cash probably. If it has less confidence in how much cash it will receive and need to pay, and when it then they will need to hold a higher cash balance, right? If they know that they can forecast more accurately how much money they are going to get and how much commitment that they have to make, so then if they are more confident, so then they don't have to hold a lot of cash because they are no for certainty they know their cash outflows and the inflows in the future. On the other hand, if they are less confident on how much cash it will receive and need to be paid, so then if they are less confident of their cash flow projection, then obviously they need to have more cash balances. Obvious. Cash forecasting or budgeting is typically performed at different frequencies and levels of detail. Obviously, when you do cash forecasting, different levels, different frequencies you can do it. It's such a simple thing. What it says is a long range, high level cash projection, not a short term, long term at high level, not a very detailed level cash projection, will be aligned with the long range planning of the organization to project the cash proceeds and needs arising from operations, capital and financing activities. So long range, high level cash projection will be aligned with the long range planning of the organization to protect the cash proceeds and needs arising from the operation, capital and financing activities. So need to ensure that you meet the long range requirement, right? Long range, then you need to have high level cash flow projections, right? Uh, uh, you need to have. This will help to inform decisions on whether to invest and how to finance the investment. So then when you have a long-term high-level projection, then you know whether you can, if you have enough cash, you can invest, or else whether you need to find financing for investment. So to do all of that, to look at long-term planning, you need to have high in long-term financial projection. On the other hand, a month-by-month forecast is typically produced. Basically, what is going to be your sales forecast, and then what will be your collection forecast, and all those things. And then based on that, what will be your cash inflows, and what are the credit terms that you're going to offer, collection rates, all those things are basically short-term financial projection. So for long-term investment and financing related things, you need to have a high-level, long-range financial projection. But for day-to-day operations management, sales, recoveries, and the payments and all of that, you need to have month-by-month short-term cash forecasting. So both are important from different perspectives. Okay, right. And then take 2 minutes. And this simple thing given as equation, just tell me whether you understand this or not. I give you 3 minutes for you to 3 to 4 minutes for you to understand this. These three equations. Just go through it. Give me a second. So simple equations, right? Your beginning cash balance, how much cash you had at the beginning, plus how much you receive, total, and you take out the cash payments, that is your ending cash balance. And then in terms of accounts receivable, outstanding from your customers, how much of collections outstanding for debtors at the beginning. On top of that, how much more sales you have made, minus what you have at the end of the period is the amount of money that you have received. How much of debtors is there? Say we had 100,000 worth of debtors outstanding at the beginning, plus we generate 1 million worth of sales. So that means you should have 1.1 million worth of debtors outstanding. But at the end of the period, you have only 200,000. So that means that 900 difference is cash receipt. On the other hand, say you have payable to your customer suppliers, plus on top of that, how much more you have purchased on credit. From total amount, but you have the amount of payables at the end of the period means that balance is the amount that you have paid. So in terms of cash, receivables, and payments, so these three equations are self-explanatory equation that you can use to, even if you don't remember them as equations, obviously you use this relationship, but is that clear? Do you want me to explain this or are you clear with this? These three relationships.
Yeah, I'm clear on that one. But we are in the assumption all sales are on credit basis and all purchases are on credit basis. Is it?
Yeah, that is why sales on account, their terminology, sales on account is credit sale. Purchase on account is credit purchaser. That is the term on account is always means credit, according to the US terminology. Okay?
Sir.
Right. And uh, speeding cash collections and slowing cash payments. So we looked at what is cash. Now here we are looking at from company's point of view, cash management. That is how well we can meet the cash requirement. But to manage that, one thing that we may do is when there is a collection that is coming, we should be able to collect it as fast as possible. And if there is a payment without damaging the reputation, the slowest we can make. So then that is the best that we can do in terms of cash management, speeding the cash collections and slowing the cash payments. Okay. So the period of time from when a payer puts a check in the mail, you're making a payment to a supplier, right? You write the check and those days you mail the check. Until the funds are available in the pay's bank is called the float. So you have to make a payment to a supplier, you write the check and you post that check. That's a starting point. And what is the time that your payee gets the money into his or her account? So that is the float, right? Companies use various strategies to reduce the float time on receipts and to increase the float time on payments. Obviously, from your selfish point of view, the longer and longer the float is, to your supplier, I uh, posted the check and your fund goes out, the longer that your float is, so you're saving your fund. On the other hand, if you are receiving money, so the customer says, I posted you the check, but you need to get it as early as possible. So then you want to reduce the float. Companies use various strategies to reduce the float on receipts. Obviously, when you're receiving money, you should reduce the float, get as early as possible, as fast as possible, increase the float when you make the payment. Obviously, that is our requirement. Right? So these terms I haven't heard these terms, of course, in the Sri Lankan context, right? But just you understand the concept and keep in your mind what the term is. A lockbox system expedites the receipts of funds. If you want to expedite how fast you are going to get the money, you can use what you call the lockbox system. Simple thing. Say you would want your customer to submit their payment to a post office box. Now these are there, but now of course all these cash transfers, everything is there. But theoretically, these are the things that have existed, and theoretically you can do them right now at this moment as well. Right? That is because making a fund transfer is always more convenient because it's you don't have to do a lot of effort. But on the other hand, this sort of procedures where you post and collect and all that, right? Making it slower, if you are making the payment, it will be beneficial to you. But of course, these things will be decided depending on the industry practices as well, even though conceptually they are available, right? So the lockbox system, what it means is customers submit their payment to a post office box. Say there's a PO box where the customers will be submit their payment, deposit the post, put their check inside. And then the bank person will remove the envelope from the mailbox. From that post box, the bank's employee will remove it from there, deposit the check in the company's account immediately. So it's your receivable, and all the receivable checks will come into your post box. The bank will take them out and they deposit it to your account immediately. And then the remittance advices are then transmitted to the company for entry into the account receivable system. So then once they do that, the remittance advice, you're immediately transferring to the company so that they can update in the accounts receivable system. The company can update in the accounts receivable system. And the bank generally charges a flat monthly fee for this service. For collecting the checks from the your box, and then collecting the check and then depositing in the account and sending the remitters advice so that entries can be made. So all of that service is provided, the lockbox system provided for some fee by the bank. Is that clear, Prasanga?
Yes, sir.
Simple idea. Let's see whether we can finish this very soon. A firm using lockbox network also engages in concentration banking. That is, regional banks that provide lockbox service to automatically transfer their daily collections to the firm's principal bank, where they can be used for the payments and short-term investment. So lockbox system, you understand, the customer will deposit in the box and the bank will deposit in your whatever the collection account and then send you the information for you to do the accounting entry. Concentration banking is that now this you maybe have collection account and you may have main account probably in a different bank. Now, say especially in US, there are a lot of regional banks, right? Unlike in Sri Lanka, you have Bank of Ceylon, People's Bank, Commercial Bank, NJB, all the banks are available right around the island. But in US, you have a lot of regional banks. Most of the banks are regional banks. So therefore, in each region, you may be working with a bank for that collection part of it, where the check comes on the PO box, you deposit and send you the information. But that collection account may not be your main account. So even though that money is coming into your account, you may not be able to use it because all your payments and etc. is done by main principal bank account. So then concentration banking is once the payment is realized into your account, the bank will make arrangements to transfer that money into your main account, not that collection account in a regional bank, but your main account, so that immediately you can use that money to meet your financial commitment. Is that clear, Prasanga?
Yes, sir.
Right. Let's see whether within another couple of minutes, 4 or 5 minutes, whatever that we can finish, we'll do it and see. The following techniques can be used to slow the cash payment. Now, here we have looked at what are the things that you can do as a person who is making the payment, how you can do, the person who is receiving the money, how you can make it faster to get the money. But on the other hand, if you are the person who is making the cash payments, you have to make it, theoretically, you have to make it slower. Like it may not matter a lot for small organization, but huge organization, even 1 hour difference, 1 day difference you may have hundreds of millions of dollars that you are saving, like, and the interest on that. So therefore, for them, it is important. The following techniques can be used to slow the cash payment. What can we do? A draft. We speak of draft. A different type of draft is a 3-party instrument. Obviously, when you say a draft, there is a person who is the drawer. I am issuing a draft. That means I am the person who is ordering. A second person who is probably the drawee to the pay money to a third party, that is a payee. So there's a drawer in between drawee and then payee. There are three parties. So the drawer is making the order, placing the order on the drawee to make the payment to a third party who is going to get the money, that is the payee. So these are the three parties. A check is the most common form of draft. So when you say draft is a generic term, so the most common form is check. Basically, it is an instrument payable on demand, which the drawee is a bank. So you are the drawer, it's your check, and you're ordering the bank to make the payment. So the bank is the drawee and the payee is your supplier, probably. Consequently, a draft can be used to delay the outflow of cash. So if you draft can be dated on the due date of an invoice and will not be processed by a drawee until that date. So you may, there's a due date, and even though you give it to the drawee, they may not be processing until the due date has come, right? Drawee until the date, thereby eliminating the necessity of writing check earlier than the due date. So you give it and give it to the drawee with the due date. So you don't have to give it in advance. So you are saving that. And using an electronic fund transfer, EFT, you use the electronic fund transfer, money goes fast, immediately. So you will be funding. It's hundreds of millions of transactions that happens in a day. So going that money faster, even the check for a couple of days, takes is your huge financing costs you may include. So therefore, what you can do is, so therefore, when you do this, if you do electronic fund transfer, immediately the funds goes. So therefore, from your point of view, it is better not to do electronic fund transfer, but probably issue a draft. So it can take a couple of days to realize, but still you meet the on paper agreement with your supplier. So that is what it means by a draft and how you can probably use that to save your financing cost. Okay, right. And then wait, now this is all what we need to look at. I will first explain the last from the bottom and we'll do it faster and then we'll come up. Payment float is a period of time from when the payer puts the check into the mail to withdrawal from the payer's account, right? So you, as the person who is making the payment, you put the check on the mail making the payment, right? And then put the check in the email, and then the time that the funds goes out from your account, that is the payment float. Receiver's float is the other hand, the other way around, payment, and until the money is received. But here, from the payer's point of view, from the time that you put the check into the this thing, mail, and withdrawal of the funds getting charged into account. To increase the payment float, the firm may mail checks to vendors despite the uncertainty as to whether the sufficient funds will be available to pay the checks if they are presented in a timely manner. So basically, you buy time instead of doing an electronic transfer, right? And there can be, the mail may take time to pass, go through, all of those things can happen. So therefore, so you deliberately buy that time instead of doing an electronic transfer, you post a check, knowing that you may be able to buy some time. Some banks offer overdraft protection in which the bank guarantees for a fee to cover any shortage with a transfer from the firm's master account. Like, so sometimes banks will have an arrangement. Of course, you have a checking account and you have your main account. So whenever there is a check comes, if you don't have enough money in your current account, so then you transfer the money into your checking account so that you can meet the payment. So for a fee, the bank may do that. So that is payment flow. On the other hand, zero balance account is basically, this is something like a margin account. So basically, at the end of each processing day, the bank transfers from the firm's master account the amount required to cover all checks presented against the zero balance account. So basically, there will be a current account type of checking account where whenever there is a payment, the checks is presented, you will be making the payment. But you don't maintain a big balance in that zero balance account. What happens is whenever there is check presented, from a master account, money will be transferred to the checking account and the obligation is made. So you're not accumulating funds in the zero balance account, but it's sweeping from your savings account to current account whenever there is a demand. So you sweep the required amount and make the payment, and that's all. Nothing will come to non-interest generating checking account. This practice allows the firm to maintain high balances in the master account. That is, yeah, you earn a return from which the short-term investments can be made. So you keep a high balance in the master account, but whenever you need to make payment, so then you will be transferring to zero balance account. So you can earn a return while you keep the money in the main account. The bank generally charges a fee for this service. So here again, the bank will be charging you a fee. Right? So zero balance account, payment flow, and then the last one, payable through draft. These terms are new to me as well because we're not in Sri Lanka, we don't use this term. Differs from a check that in that it is not payable on demand and the drawee is the payer, not a bank. Right? So basically, payable through draft, in the case of a check, what happens is you are drawing it on the bank and the bank is the one who is going to make the payment. Right? But here the drawee is the payer and not a bank. Like you are instructing someone to pay who is not a bank, so then the payable through draft. After the payee presents the PD to the bank, say if the payable through draft, you present the payee, the person is receiving the payment, they present to the bank, and then the bank in present it to the person who issued that, the drawer, and then the issuer will deposit sufficient amount of funds to cover the payable through draft. It is a slower process. The bank is not the person who is going to make the payment, but the individual, the bank will be requesting the person to make the payment upon the submission of this payable through draft. The use of PDT allows the firms to maintain lower cash balances. Again, you buy time. Drawbacks of this technique include the following. Vendors prefer to receive an instrument that will be paid on demand. So the vendors may not prefer to get the money in that form. Banks generally impose a higher processing charges for that. Yes, the banks also may be charging a higher amount because their involvement will be more. That's it basically what you're going to discuss about the cash management. So we started from here, current asset management, working capital and cash management. So this is what we have been discussing up to this point. And the next lecture, we'll be looking at receivables management, a couple of pages, and then inventory management, a couple of more pages. Receivables management and the inventory management. That's what we're going to discuss at the next lecture. Are we okay?
Yeah, sir.
That's it. We took a little bit of time, but at least now that segment we finished. Otherwise, small components we may keep corners.
Anyway, you made that target.
Okay, yes, finish this. How is everything, Prasanga?
uh, yeah, there are a couple of new things as we discussed in the last point. TVO, what is the abbreviation I could find, but new concept in Sri Lanka. We have money market bank account, SIF bank account, all those things. How to manage daily the cash surplus or deficit. I think new concept.
Yeah, few things are new. Yeah, that's it. Okay. So good that so you have clear understanding. So you should be able to meet the whatever the MCQs that you're going to get. So shall we call it a day with that?
Yes. Thank you
And
very much. Thank you very
my
much, sir.
pleasure. And we'll see by next Wednesday. Also, actually, I also need to do some preparation work. Let's try and see whether we could finish this by whether you could have the next topic next Wednesday without delaying it. Okay.
Okay, thank you, sir. Bye. Good
Right.
night.
Good night, Prasant. Good night.